Hi everyone and welcome to Wall Street Multimedia's Market Watch. I'm Tiffany Liu with the latest market news. It's a bad week for tech stocks. All three major U.S. indexes declined for a second straight session on Wednesday as tech giants released disappointing results. Apple shares fell 4.3% in response to a lower than expected sales outlook, accounting for more than half of the Dow's 68-point drop. Microsoft also fell 3.7% after posting a $3.2 billion quarterly loss, its biggest ever. Thursday saw U.S. stocks trading flattish at the start before the Dow extended losses for a third day, dropping about 100 points midday after 3M and Caterpillar both cut their sales forecasts. Now let's turn to Ben Willis, who will give us his expert commentary on the U.S. stock market. So this week we saw lackluster quarterly results from Apple, Microsoft, IBM, and United Technologies weigh on U.S. markets. Does this stock slump translate to any structural changes in tech sectors going forward? And what can investors do if they want to take advantage?
There is a structural change, if you will, but I think people need to be careful in the fact that Apple actually reported extraordinarily great earnings. What was the inference in the earnings numbers? It disappointed those people who thought they'd be even better, particularly the sales in China. The disappointment in the sales of China was the single biggest factor to me that drove Apple stock down that day. Then you had news out of Microsoft. You continue to have companies that have exposure to China, which is the second largest economy in the world, that helped recover, save the world economy, if you will, over the last 5 years because we were allowed to export into China. We're seeing a transition now where China may be slowing down from that 10% GDP growth rate down to a 7% growth rate. So that being said, you need to adjust your investment horizon and where the growth is going to come from. And that's one of the major reasons Apple sold off. So it's not necessarily disappointing earnings. It was disappointment in the speed or the velocity of earnings, particularly out of China.
Given all the external factors like global economic growth and oil prices picking up in the second quarter, does the current earnings season differ from previous ones? And which numbers should investors really be looking at?
Well, unfortunately, it's going to be stock specific. As I said earlier with Apple, if you looked at Apple's headline, their earnings were extraordinary. The billions of dollars that they earned was absolutely incredible. But if you didn't follow the individual stock and know what the fast money players were looking for, you didn't realize the stock was going to be sold off very dramatically. The anticipation of earnings for this quarter that we're in right now had been a very much lowered bar. It's usually one of the lower expectations of the quarters. So that being said, most of the earnings we're seeing this quarter are actually much better than anticipated. So that tells you there is a bullish trend underlying the overall market, and you should anticipate that. So again, buy the dip mentality has come back in. I would caution that to say I'm looking for a correction. Not as quite as severe as we saw a correction in China, but the United States stock market could use a correction, but you may not see it in a broad sense. You may see it stock specific, like we saw in Apple, or like we might have seen. We actually saw a small correction in Chipotle Grill, which is an American company. The correction happened overnight. By the time it reopened, the correction was done and the stock traded higher. So it's stock specific, really, rather than a broad market.
What is the market sentiment right now, and how do you think U.S. stocks will perform in the near future as earnings continue to be released and the Fed considers a rate hike?
I believe that the United States market is still in bullish trend. It's still to the upside. I'm hoping for a correction because I think, quite frankly, that's healthy for a market. I go back to the analogy of a rose bush. You need to prune a rose bush if you want to continue to blossom. Stock markets are very much the same way. And we have not had a 10% correction in over 1,400 days. That's an extraordinary amount of time to not have a pruning. So I would hope that would happen, but that's not a negative. That's actually a better opportunity to put even more money to work in the stock market than to avoid it. So at this point, I think the long-term trend still is up. I think investors should be looking to buy individual stocks, however. I think that the 2-3 years ago where you could buy the stock market, buying the S&P indice or buying a basket of stocks was an easy way to trade. I don't think that trade's really good anymore, a safe bet for the individual investor. You should be looking in buying companies you know and understand and save some money to buy them because they're probably going to be cheaper.
That's it for this episode. I'm Tiffany Liu, and thanks for watching Market Watch. I'll see you again next time.